Hello, everybody. Luke Gromen, FFTT. Hope you had a great weekend. I know I had a great weekend. It is a great day to be a Cincinnati Bearcat. My Bearcats are in the college football playoff. It was highlighted after taking care of business in the AAC championship game. So, a shout out to my friend Chase Taylor at Pinecone Macro, who's a University of Houston guy. We got to hang out at the Cincinnati game on Saturday, as you may have seen on Twitter. So it's fun catching up. And with that, we are going to jump in. So, first question's from PM. Can the Fed taper to zero bond and MBS purchases per month in 2022 while keeping their balance sheet steady, neither purchasing nor selling? And why couldn't that be a sustainable situation for markets into perpetuity? I think it depends on context. If the dollar is falling, if inflation in the U.S. is running, call it 6 to 7%, just to pick a high but not too high number, nominal GDP running 10%, I think they could do what you describe. You would have the falling dollar, you'd have strong growth, and that would allow the emerging markets, rest of world, and global private sector to have the capacity to finance what are expected to be $1.7 trillion in deficits. Now, the challenge, of course, is the private sector going to want to buy treasuries at yielding 1.5 when inflation's running 6 to 7? The answer is probably no, but the official sector might have to soften their currency relative to the dollar, keep their currencies from getting too strong against the dollar. However, another context, if China's slowing, if the dollar's strengthening, emerging markets are going to be slowing, U.S. GDP will be softening, deficits are likely to widen from the $1.7 trillion in estimated deficits for 2022. And then who buys them? Your emerging markets, your rest of world, they're going to be selling treasuries in all likelihood to prop up their currencies. Fed's balance sheet, or one of two things is going to happen. Either the Fed's balance sheet's going to go up, or U.S. Treasury rates are going to go up. A simple supply-demand equation solved by either the Fed's balance sheet going up or interest rates going up. So there are a few potential offsets to that. The reverse repo, has $1.5 trillion in cash. If some of that cash dollar liquidity makes its way into the system, that could be an offset conceivably. As we've talked about before, standing repo facility and foreign swap lines also could help provide dollar liquidity offsets, but those are really just QE without calling it QE. So, next question from Hume. How much inflation does the U.S. need to shrink their debt, and over what time frame? The way we've looked at it is we compared it to 1946, where post-World War II, debt to GDP was 110%. The U.S. got it down to about 60% over 5 years, or a 50 percentage point reduction over 5 years. So we ran a simplistic model earlier this year. It assumed 130% debt to GDP down to 80% in 5 years, with 8.75% CAGR growth in the underlying debt, which is what it's been for the United States since 1Q08, continuing throughout that period of time. And what we concluded was that you needed 17 to 20% inflation annually for 5 years to delever 50 points that quickly. You could do it faster with more inflation, of course. You could do it slower with less inflation. Either way, bonds get killed on a real basis. Now, interestingly, you can make the point, look, Luke, we've gone from 135% to 122% with CPI peaking at 6%. And that's a good point. In theory, maybe it would only take 6% per year for another 3 or 4 years to get us there. I would argue that the 6% is probably not the right number. When used car prices in the United States are up 60%, 60, I question if inflation's really running at 6, but that's neither here nor there. What it does say is 15 to 20% inflation. Maybe that's negotiable. Maybe it's 10 to 15. Maybe it's 8 to 12. But all of those numbers are way above current yields on treasuries, and so again, you're going to put pressure on the other side for the Fed to cap yields if you try that output. Either way, they're very high rates of inflation relative to what we're used to for an extended period of time. From BC, will European countries be forced to buy treasuries? Will the U.S. use its military dominance in order to enforce treasury buying among allies? The Europeans have already played that role for us. They essentially stopped. They were the biggest marginal financiers of the U.S. in the 60s and 70s, into the 80s, alongside Japan. Post Euro launch, the EU all but stopped buying treasuries. Those surpluses, the surplus nations in places like Germany in particular, were redirected away to the Eurozone. And so the U.S. needed a new financier. After the euro was launched in 1999, the U.S. needed a new financier. Enter China. China gets into the WTO at the end of 2001. At the end of 2001, China held $60 billion with a B in treasuries. 10 years later, they owned $1.3 trillion in treasuries. However, China all but stopped buying treasuries on a net basis in 2014. Same story as 99. U.S. needs a new financier. Who is it? Since 2014, one of, if not the biggest marginal foreign financier of the United States have been what my friend Chris Hamilton at Economica calls the BLICS, B-L-I-C-S. Belgium, Luxembourg, Ireland, the Cayman Islands, and Switzerland. Tax havens and hedge funds has been the biggest marginal source of foreign demand for treasuries since China all but stopped buying on a net basis in 2014. And so you say, okay, how many treasuries can the Cayman Islands buy? The hedge funds stored on the Cayman Islands can buy a lot, and they have. Not stored, but domiciled on the Cayman Islands. So the U.S. here again needs a new foreign financier in theory. It's not the EU. It's not China. Japan's doing what they can do, but they're probably not good for the size of deficits we'll run on an annualized basis. Maybe Africa, but then if Africa does it, the U.S. needs to run major deficits against Africa to supply them the dollars to buy the treasuries. It's unclear to me what we would run deficits in those amounts against Africa in. And at any rate, China has spent the last 10 years taking the dollars we sent them and buying up lots of Africa, so I don't know that the Africans would even be interested in doing so. India, not running big enough deficits. Mars, maybe that's why Elon Musk wants to go there, I don't know. But in all seriousness, the only balance sheet left is the Fed. And so that's what we've seen. I think we're just going to continue to go through iterations of that until that becomes more widely understood. When you say, can the military force people, I think that's always been sort of the game. It's protection. The question is protection from whom? First, it was protection from the Soviets. That's not needed anymore. In theory, it's needed against the Russians. I don't know that that's the case. Then you need protection against terrorism. Do we need protection against China? Hard to make that case when China is most of these countries' biggest trade partner, not the United States. And at any rate, if we're going to expand the military, who's going to finance that? Same problem as before, only the Fed. Okay, KW. A common argument against owning gold is that in the exact time you want it most, when the Fed revalues it, the government will deem it illegal to own right before they do the revaluation, make you sell it to them, i.e. 1933. What are your thoughts on this potential scenario repeating? In my opinion, that's unlikely. So, for example, in 33 and in 1914, when gold was seized in the U.S. and around the world, it was money. It's private property now. If nations can seize gold, they can seize your house, and quite honestly, they could seize your 401k and your retirement assets, where maybe there's $500 or $800 billion of private gold in the U.S., but there's $30 trillion in private retirement assets. It could be taken with a few keystrokes, in theory. So I don't think it's very likely that gold could get seized. Now, with that said, I think if they were going to do a revaluation, here too, because it's not money, I would think the governments would actually want you to hold the gold, because basically you're going to turn around and hand them gold for cash. You're going to take that cash and those depreciated dollars and buy real assets, reinvest in the economy. That's actually the whole point, is you're basically, the revaluation of gold is to recollateralize the balance sheets of central banks, write down debt. If you seize the gold or you take the gold off people before then, you sort of defeat the whole purpose, in my view. From SF, your two horses, one ass analogy. At what point does the Fed have to choose a horse? I'm assuming there are a few different scenarios that force this decision. What do you think that moment looks like? I think the Fed has to choose the horse when inflation gets high enough that it's a political problem before the debt is low enough that the Fed can raise rates without blowing up the economy, blowing up markets, blowing up foreign markets, etc. And I think I don't know that we're at that point yet, but we're moving quickly toward that point. And what I mean by that is all of a sudden the Fed is feeling pressure on inflation. Inflation is becoming a midterm election issue. The Republicans are harping on it. I think the inflation is still largely a political issue more than an actual hardship issue. My thought is that it has to get to a real outright hardship issue where the first thing you're talking about is how bad inflation is at when you talk with your friends, you go to parties at Christmas, at holidays, etc. I don't think we're at that moment yet. I don't think we're all going to go home to the holidays and say, the first thing mom and dad are going to say, gosh, inflation's killing me. I think that's where it needs to be, but that's the type of thing I think you need to see that then forces the Fed into choosing one horse. From NP, what do you expect to see as signposts showing that we've arrived at the end game, i.e., next Fed meeting will be an emergency one saying the equivalent that Bretton Woods is dead, right? Revaluing gold, China, Russia trading at gold, trading gold at 1,000 barrels per ounce of gold, whatever some of the cases we've laid out before. I think the end game moment is what would precede that would be a broad recognition that the Fed and other central banks are cornered, that QE is financing rapidly rising deficits, and that politically deficits are going to need to grow further and faster, and as such, that global sovereign debt is an asset class that is devalued, is going to be devalued significantly in real terms, that it's going to be a certificate of confiscation for years to come. I think that has to be just broad, overwhelming consensus, or moving toward that as one precursor. I think explicit yield curve control or its equivalent is a likely precursor where you have consensus arrive at the conclusion that real rates are heading towards negative 15 to 20% for a span of several years, or to negative 10 to 15% for a span of several years. And I think once you reach that conclusion, once consensus is there, then things move fast, because you just can't store surpluses in sovereign debt that has a negative 10 to negative 15, negative 20% real yields. You have to move to something that preserves purchasing power, and that would, I think, be the precursor to some sort of systemic reset like you were describing. From OO, are we at the end of a 50-year long-term debt cycle, or do rates go up for decades? End of 50-year cycle, but I think we're also at the end of a 100-year sovereign debt and sovereign promise cycle. If we take a step back and look and see what's really happening, if we look for the forest for the trees, sovereign promises for the last 100 years have all sort of been slanted in one direction, which is reduce savings, reduce personal responsibility in favor of the government backstopping you, and bring forward consumption. And they've done that via debt, via entitlement obligations, etc. And I'm not making a political statement on whether that's right or wrong to do. It just is. Now, though, the bills do. And so rates going up on a nominal basis quickly bankrupts that system, particularly since so much of the system's consumption, tax receipts, GDP, etc., are based on rising asset prices, most of those asset prices are interest rate sensitive in one way or another. So rates going up bankrupt the system. So in my opinion, it's more likely that real rates get increasingly negative for years to come until we reach a tipping point where we can get some sort of systemic reset, or where some sort of chaos happens where a systemic reset is sort of the last issue left. And then finally, from VB, do you think that a central bank digital currency would elevate the system to the next level by adding new features to the money? In my opinion, a central bank digital currency effectively cuts out the banks. It's the central bank effectively sending legal tender to citizens who would have a bank account at the Fed. Dr. Lacey Hunt, the always brilliant Dr. Lacey Hunt, didn't mince words about this development, said that it would lead to hyperinflation. And those are his words, not mine. He's very precise with his language. He's not known for being hyperbolic. So I think it would be extraordinarily inflationary. Now, to the extent of what we've just discussed for a lot of the last 10, 15 minutes, I think ultimately some version of this is what's needed. You need some high rate of inflation, not hyperinflation, but some high rate of inflation for some extended period of time to normalize debt and sort of get the system back to normal, basically resetting the system over the backs of real losses, purchasing power losses by bondholders. So now, I would also say that central bank digital currency would be a very frightening political development. And I was watching something by a presentation by my friend Jeff Booth recently where he called central bank digital currencies surveillance disguised as money. And I think that's a brilliant summary of what it is yes, everyone says it's just going to be for stimulus, but it opens a Pandora's box where suddenly, if you don't vote for the right people, suddenly if you speed in your car, suddenly it opens the door for the central bank to motivate or demotivate you via a Chinese-like social credit scoring system. Where you get money debited or credited from your account based on behaviors seen as beneficial. And that means basically the Fed and the people who control the Fed have complete and total control over your life. And that is, to me, horrifying. So, to me, I don't think a central bank digital currency is a good thing. It is what it is. So, at any rate, a little bit of a depressing note, unfortunately, to end on today. As always, thank you for joining me. I appreciate you tuning in. If you're interested in more about what we are up to, check us out at FFTT-LLC.com for more information about what we're up to or what we're working on, public appearances, and you can also check out our product Tree Rings if you like these updates. 10 most interesting things every Friday delivered to your email inbox. Brief synopsis on some of the key things that we're looking at, reading, seeing, and why and how they may impact markets. We get a ton of great feedback on that piece every week. So appreciate you tuning in. Everybody have a great week and go Bearcats. Take care, everybody.